Jeremy Siegel, the Wharton School professor of finance, and he joins us live. Okay, you're getting ready for the game tonight. I'll forgive you.
Yeah, less than 5 hours away.
Well, I know who you're rooting for. I know who I'm rooting against. Let's put it that way. I'm hoping for a tie, actually. It's good to have you.
Thank you.
Is a lot at stake tomorrow, or is it already a done deal, do you think, for September?
One cut's a done deal. 2 cuts would be in play with a negative print and, no other, substantial revisions that argue otherwise. In play, I would say the odds are still 1. And, you can't say whether there's going to, I really think there could be 1, 2, 3 for the next 3 meetings. Because I really think that, what the Doves want is to get down to near neutral, which is the 3%, 3.25% range. And that's eventually 4 cuts by, let's say, the middle of next year. I think the Fed funds rate, as I said many times on your program, should be about 100 basis points below 10-year. We're about 4.25 on that 10-year. So, 3.25 on Fed funds is the direction we should be heading for in the next 6 to 9 months.
Do you think the economy is actually weaker than some of the more optimistic people would like to believe?
I think there's still we haven't yet seen a lot of price increases. A lot of it has come out of inventory that was bought before the tariffs. Now, this third quarter, they're going to come in, and we're not really sure how much is going to be absorbed by the retailers, which does cut margin, how much by the foreign sellers, which of course doesn't hurt us or our companies, and then how the consumers will react. So I think the market is sort of watching. Are we going to start talking a lot about those tariff-induced price increases in late September and October, and is that going to affect consumer confidence? That said, I don't see this bull run over, as you said at the beginning so accurately, Scott. You don't want to sell right at the beginning of a Fed cutting stage, no matter how long it will go. So I still think, we could see 5 at most 10. Clearly, we're much near the top, then at the bottom of this bull run, but I don't think it's out of juice yet.
Wait, could see 5, maybe 10 what? 5 or 10
percent
what?
more on the S&P. Yeah, 5 to 10% more. I'd take 5 and then kind of let's wait and see how much of the price increases are going on. But 1 cut is in there. 2 cuts is an option depending on how weak the data does come. And, as Waller and others have said, the data, labor data can turn very quickly. And, we haven't seen anything yet. Stephanie was right, just a little bit inching up in those jobless claims, but nothing. When they start going up, really, we start seeing jumps of 30, 40 and more every week. We have not yet seen that. And, I hope we don't, but that certainly is not out of the possibility.
But when you throw around 5 or 10% more, do you think 7,000 by year end is really possible?
Well, let's see. We're at 6,500.
65.
So,
We'll call it 65.
Yeah,
you think I'm going to get a cut in
another
September,
500
October,
is
December?
8%. At that time, I said that's possible. I would. If you have to ask me, I would say, likely not that high because, there are a lot of challenges. It's going to be the court challenge to the tariffs. There's, going to be a lot of, Fed rigmarole on independence. And, of course, I think the most important thing is are the consumers finally going to see that price increase? Though we still believe that it's a one-time bump of, I think, 1 to 1.5% in the CPI. And, the media is going to be all on top of it, interviewing shoppers. I saw this at $10 for, the last 3 years, and now it's $12.50. Is that going to scare consumers or not? So I think that's a lot of uncertainty that will keep a lid on any, massive bull run for the rest of the year.
All right, Professor, we'll leave it there. Thanks for the time. Enjoy the game. We'll see you soon. This is Jeremy
Thank you very
Siegel
much, Scott.
of the Wharton School.